Hey everyone, welcome back to Corporate Decoder, the place where we decode the often confusing language of corporate filings. Today we're diving into a Form 8K, a quick update from Northern Revival Acquisition Corporation. It's about a meeting that got pushed back, which might not sound exciting, but sometimes the smallest details hint at bigger things. We'll unpack what this delay could mean. So what is this Form 8K all about? It's basically a corporate breaking news report. Companies use it to tell investors about big unexpected events that could affect their stock. This one comes from Northern Revival Acquisition Corporation. The key date to remember is May 1, 2025. That's when this event happened and when the company filed this report. It is also the end date of the reported period. Let's talk about the company itself. Northern Revival Acquisition Corporation is what's called a special purpose acquisition company, or SPAC. Think of it as a blank check company. It's created to raise money and then find a private company to merge with and take public. Basically, they are in the business of buying other businesses. The company is officially based in the Cayman Islands, a popular spot for incorporating businesses for various legal and tax reasons. Nothing scandalous about it by itself, it's just where they are incorporated. Their commission file number is 001-39970. This is like their ID number with the Securities and Exchange Commission, or SEC. The address of their main office is 4001 Kennett Pike, Suite 302, 2 Wilmington, DE 1987. Their phone number is 302-3310 314-30. Now, there are a few boxes checked here regarding whether this filing is also meant to cover other types of communications, such as those related to mergers or acquisitions, but all of them are marked no. This indicates that this 8K is specifically for the event it describes and not part of a larger ongoing process. Here's a rundown of the company's listed securities. NRSCU are the units, each containing a share and a fraction of a warrant. NRS represents the Class A ordinary shares themselves, and NRACW are the redeemable warrants which give the holder the right to buy shares at a set price. All of those are NRISHAND. The company identifies as an emerging growth company. This means they get some leeway in terms of how quickly they need to adopt new accounting rules. Okay, here's the heart of the matter. On May 1st, 2025, Northern Revival Acquisition Corporation announced the adjournment of its extraordinary general meeting to May 2C. They had a meeting scheduled, but they had to postpone it to the next day. This is the entire point of the report. Now, why does this matter? General meetings are where shareholders get to vote on important company decisions, usually mergers, acquisitions, or other big changes. Delaying the meeting suggests they might not have had enough votes to pass a proposal. It is possible that a quorum was not achieved, meaning not enough shareholders were present to hold the vote. What kind of proposal could this be? Since Northern Revival is a SPAC, it's highly likely the meeting was about approving a merger with a target company. If they don't get enough votes, the deal could be in trouble. The consequences for the company failing to complete a deal may be huge. SPACs have a limited time frame to find a company to acquire. If they don't, they have to return the money they raised to investors, which could cause reputational harm. And to now, let's give our opinion of the situation, and now let's give our... If they don't, they have to return the money they raised to investors, which could cause reputational harm. And now let's give our opinion of the situation. Northern Revival Acquisition Corporation is in a tough spot. SPACs are under a lot of pressure to find good deals, and this delay suggests they're having trouble getting shareholder support for their chosen target. The delay in the shareholder meeting raises a red flag. It suggests that either the company's management failed to convince the shareholders of the target selection, or that some major shareholders decided not to support the deal. Either way, it's not a good look. This could lead to a few outcomes. They might have to sweeten the deal for shareholders to get their approval, or they might have to walk away from the merger altogether and look for another target. Both options could be costly and time-consuming. The risk is the shareholders might pull the plug. While the company is struggling to reach an agreement, they still have time and resources to pursue alternative strategies. If they can communicate clearly and transparently with their investors, they might be able to regain their confidence and successfully complete a deal. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more insights into the world of corporate filings.